Welcome to Global Money Talk, brought to you by SamPro.TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming from you from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and today I'm joined by Simeon Hyman, Chief Global Strategist at ProShares. Simeon, thank you for coming on the show again.
Thanks for having me.
How are you today?
All good, all good.
So just to get started, big things over the past week. The market digested two big events last week. Let's talk about the first one, the election. Huge rally in various indices. Is it sustainable, or is this sort of a knee-jerk reaction?
I think the first leg of that rally was relief that there wasn't uncertainty. We all thought we weren't going to know who won the election for a month, maybe more. And the fact that we knew right away, that was indeed very comforting. But the rally probably does have legs. The policy implications do start to be meaningful. We may have tax cuts, we may have further fiscal stimulus. The tariffs are a little bit of a wild card, but for the most part, and a little bit of deregulation, for the most part, the market is interpreting the new administration as pro-business and probably at least a modest stimulus to growth.
It appears that the Republicans are going to sweep the House and the Senate, and as well as take the presidency. Historically, it seems that the market seems happiest with a split government. If it's a sort of all Republican government, do you think the market has any concerns about that, or even if that does, is it showing? Is it perhaps not showing yet?
So this is very interesting. What you just said is what I thought. And what many of us were taught. I think there were some guys at UCLA who ran these numbers about 30 years ago. And one of the things that was found in that research back then was indeed the notion that a split government was best for markets because markets like stability. And if there aren't a lot of changes, that's good. But we ran the numbers just before the election. We published a piece and found nothing.
Really?
Looking just at these last 20 or 30 years, we actually found basically nothing with regards to Republican versus Democrat. Yes, a little bit of outperformance under Democratic regimes, but not statistically significant. And surprising me, we saw no statistical relevance to the gridlock theory. So at least over the last several decades, the market just doesn't seem to care. It may be more about what policy does get done than anticipation.
Do you think, and just to dive down the rabbit hole a little bit, if a Republican gets elected, and they start looking at the next 4 years, is there so much move in the before the inauguration that the market is coming from a higher base, or just for the sake of argument, if it's a Democrat, does it sort of retreat and then it's coming from a lower base? We should see any part of that at all?
We really saw no relationship between administrations and market movement. Clearly, we're having some anticipation right now, and it will come down ultimately to earnings. I mean, that's what it's got to come down to. So take the wild card of tariffs. We just don't know. It does look, if you look at the sectors that are outperforming, and you look from a market cap standpoint, part of that small cap rally is the fact that small caps are less exposed internationally, a little bit more domestically focused. So there is some stuff that's being baked in as part of an anticipation of what might happen, but it's going to be a little bit wait and see.
I think we'll come back to small caps in a little bit, but the other thing we also got was the Fed decision. And how do you think the market, what did you see out of the Fed decision, and how do you think the market reacted to it?
The inflation and employment backdrop is pretty darn good right now. It really does look like we're having a soft or no landing. We've got CPI, PPI, all trending very close to that 2% target. A tiny nick in the labor market, but nothing disastrous. And that's what we heard from Chair Powell. We'll take the 25 basis points, and we'll see where it goes. If you're looking forward, I go by the following rule. 2 plus 2 is 4, maybe 4.5. Meaning that the long-term average of the 10-year Treasury yield is somewhere between 4 and 4.5%, which is about 50-50, 2% inflation, 2% real. Now, if you have 2% inflation, the federal funds rate is likely to land somewhere around 3. So now we've got the yield curve. We've got 2, 3, 4, 4.5. Which one has already happened?
Okay.
The 10-year bond is already in its equilibrium spot. So we'll probably be range bound on the long end, and who knows exactly when we'll get to 3, but sometime in the next 12 to 24 months, we're going to probably get to 3% on Fed funds.
Okay. Now, when you were a guest on the show a month ago, you had an interesting metric. You said, and I think the 10s were probably a little bit low, 10-year yield was a little bit lower then, but you said, if it gets to 3.5, it signaled the market's really worried about something. If it gets to 4.5, the market's really worried about inflation. What's happened in the past month? Would you shift those sort of warning signs or levels?
No, I think that's a good way to look at it. Yeah. So in other words, the only way we breach 3.5 is if there's real economic weakness. If it really looks like there's a hard landing, geopolitics go the wrong way, or something on a policy front is so askew that it really dents GDP. So that's kind of a floor of a soft landing. And on the high end, look, we are getting close to that 4.5, which is the market saying there may be whiffs of inflationary pressure from expansionary fiscal policy that may be to come in the new administration.
So would you, for the investors who are more sort of fixed income oriented rather than perhaps equities, or perhaps they, you mentioned last time, maybe we can actually do the 60-40 again, these days, because fixed income the yields are high enough for it to be a legitimate hedge. Would you recommend, maybe, buying 10s or buying bonds at around 450 and then selling them towards 3 3/4 is a little bit of a trading range? Is that a reasonable strategy?
I think the challenge on the fixed income side comes from 2 directions right now. Number one, the Fed has given a salary cut to people who are invested in CDs, money markets, short end of the curve. But there is this little whiff of price pressure on the long end, meaning that if we could drift north of 4.5 if there are inflationary pressures from too much fiscal stimulus. So you squeezed a little bit on the fixed income side. In the meantime, the equity backdrop looks pretty good, and this reinforces something we've seen over the last few years, which is more and more folks looking for ways to generate income from their equity portfolio.
Now, I want to go back to a little bit to, you mentioned small caps. Small caps have had a tremendous rally. So I guess people might be saying the S&P 500's at 6,000. The small caps actually, in terms of really rallied pretty hard. I think the Russell might be up somewhere around 7% or so. Do you think is that sustainable, or it's a little bit of a false dawn on because small caps have really sort of underperformed the bigger indexes over the past couple of years?
Small caps have underperformed not just for the past couple of years, but for about 15 or 20 years. And yes, many of us have been calling out the valuation discount, and the question always is, we got a little rally, is it a false dawn? We had one in the summer. We had a massive July of small caps, and then of course last week with the election, small caps were up 6% the night of the election. We suggested it might not be a false dawn. First of all, the discount's still there. On a price-to-book basis, small caps are running half the valuation of large caps. Second of all, they're the ones that are sensitive to Fed cuts. Now, this is a little tricky. I mentioned that the long end of the yield curve is probably in a relatively range-bound landing place. The long end is what drives large cap valuations. So don't expect a lot of action from the Fed on in large caps. But in small caps, because they're more leveraged and have shorter dated paper on their books, they're sensitive to the Fed. So that's another tailwind. And then finally, as we mentioned a few minutes ago, the more domestic focus is going to be something that may benefit small caps in the event that some of these tariffs do come through. So we don't think it's a false dawn. Particularly, we're quite interested in the Russell 2000 Dividend Growers Index. A good way to get small cap exposure, companies that consistently grow their dividends in small cap jack up the quality, make it a little bit of a belt and suspenders approach to the asset class, and there's a little bit, in fact more than a little bit of an overweight to small cap financials in that Dividend Grower Index, and that's a nice place to be with the steepening yield curve.
Now, is that the SMDV?
That's the ticker. That's the ProShares ticker indeed, and it follows the Russell 2000 Dividend Growers Index.
Right, right. Now, in terms of sometimes, and I was actually, I remember you talking last time, I was a little stunned to hear when you said 2/3 of the Russell 2000 doesn't make any money, which is, the companies in the Russell 2000 don't make any money, which was a little bit of a surprise. I hadn't, I'm not that much of an equity expert per se, but I was surprised. So there are different small cap indexes. There's sort of the S&P 600, the Russell 2000. Do you look at sort of different indexes and you favor one over the other or something like that?
We do think this is an opportunity to take a higher quality approach to small caps. And yes, the 600, the S&P 600, does have higher quality than the Russell 2000. We just don't think you have to stop there. By using a screen for companies that have grown their dividends, the Russell 2000 Dividend Growth Index are companies that have grown their dividends for at least 10 straight years. That's a real high quality approach to small caps, perhaps even higher quality than the 600. And look, it's all on such sale right now. There's really no reason not to have a higher quality approach.
Right, right. And I guess if you're right, and we have, if you think the Fed will finish around 3% in Fed funds, I'll make the sort of the twos and the fives, where probably a lot of these small caps are borrowing, a lot more attractive and help them.
It can really help them out, but not so much the large caps. It's really, for the most part, a benefit to smaller companies.
Right, right. Now, so what about on the topic of large caps? Large cap dividend growth, or what's I guess that, and what do you think the outlook is for the big engines that have driven some of the eye-opening rallies that we've seen in the S&P?
There's definitely a rotation underway. I think everybody's cognizant of that, and indeed we think the dividend growth screen is historically a great way to approach large cap stocks as well. The S&P 500 Dividend Aristocrats is one of the most well-known indices in the space, and look, it's been an underperformer. Because tech and the Mag 7 have run so far, so hard, the dividend growers have been left behind in a way that we pretty much haven't seen since the tech bubble burst in 2000, right before that. And in fact, all of these dividend growth indices, including the Russell 2000 dividend growers and the S&P 500 dividend aristocrats, they're all equally weighted portfolios, which again is a particularly good time to think about an equally weighted approach, but not just equally weighted. So one of our kind of taglines that we use in trying to communicate this is the notion that equal weight's not enough. If you equal weight the S&P 500, you degrade the quality of the S&P 500. Return on assets is cut like in half. But if you equal weight the companies that have grown their dividends consistently, like the dividend aristocrats, you actually have higher return on assets than the S&P 500 off the shelf. So equal weight, not quite enough, but if you equal weight a quality basket like the dividend aristocrats, you have a really powerful combination to take advantage of, let's call it we may not be in the ninth inning, but we're not in the first inning either of a rally. So a high quality, equal weighted approach to large caps can make a lot of sense.
And I love the fact that the ticker is Noble, and you guys have aristocrats, and it's almost sort of antithetical to the thinking about equity. How did you guys come up with that that ticker and the idea about aristocrats?
Ticker selection is an art form in this business, and indeed, Noble and aristocrats did seem to be a very nice combination that really expressed what the ETF was all about and what the index is all about.
It's sort of like kids would call them. It sounds very bougie, and it does. It's very memorable. And when we're looking it up, I thought it was quite clever, actually. I want to move on to a little bit about commodities. So oil prices have had that spike. Concerns about the Israeli retaliation to Iran earlier in the fall. But generally, energy prices are falling. What are your thoughts on the energy sector overall?
Here's what's a little bit of a disconnect right now. Oil prices are low, and in fact, to your point, they've come down since we had some escalations in Mideast tensions, but since the election, they're down. Oil prices are down 7 or 8%, and they're quite low. But earnings expectations for the energy sector are actually, I would argue, pretty aggressive for 2025. gross margins are, on a consensus basis, are expected to expand in 2025, even after they expanded in 2024 in this low oil price environment. So I think that does suggest that there's a little bit of pressure on the sector. And look, energy is only about 5% of the S&P 500. So it's small enough that prudently, if you think there's a mismatch here, you might just want to zero it out. You can't zero tech out of your portfolio because it's 30%. It's too much risk. You'd have to be clairvoyant. But energy's 5. There's an S&P 500 X energy index, which can be a very interesting way to think about exposure to the S&P while leaving that behind. Could we be wrong? Could drill baby drill turn around the sector? But on the other hand, drill baby drill may drive energy prices even lower. Right. So I think there's so many other places in the equity market that have a better risk reward profile right now that it just seems like a little bit of mismatch between the underlying prices of the commodities and the earnings expectations for the sector.
It seems hard to think that the equity, the names will do well when you're expecting expanding margins, but the prices are falling. So where's that margin expansion going to come from? You can't get that much efficiency, quote unquote, out of the sector unless all of a sudden you find fields that I guess are really easy to access. So that's a good point. So I guess the view is maybe leave it alone, but certainly it's not the time to grow the energy sector.
From our perspective, yes.
Yeah. So one of the things that really has fascinated me about it, and you mentioned it last time you were here, is ISPY, which is you'll probably describe it better than I do, but it's the S&P 500 high income, I guess, is that the right way? Is it high income S&P 500 ETF?
That's right. It's the S&P 500 high income ETF. And it is an index-based strategy, and it follows the S&P 500 Daily Covered Call Index. It's a very powerful innovation. As I mentioned at the beginning of our conversation, with challenges on the fixed income side, a lot of folks do need to look to the equity portion of their portfolio for some income, especially with the baby boomers retiring.
Right.
And if you retire at 65, you might live 30 more years.
Sure.
So you can't just have fixed income. You won't make it to the finish line. But you probably need more income than your fixed income holdings could deliver. The challenge on the equity income side is that many of the approaches to equity income sacrifice way too much of the return of the equity markets. And that's what this innovation of the S&P 500 Daily Covered Call Index is all about. A traditional covered call strategy. This is when you sell the right for someone to buy your stocks away from you. So by definition, you are selling away the upside. And a traditional monthly approach to covered call strategies only delivers about 1/3 to 1/2 of the return of the equity market. Way too much of a sacrifice. But the S&P 500 Daily Covered Call Index is a great way to still get income from the covered call approach, but generate the full returns of equity markets and capture the returns that traditional strategies have left behind.
Let's dive a little bit into sort of the guts of this. In terms of I guess the index and your ETF would sell a call on the S&P 500. How far out of the money roughly would you say it is?
Yeah, the index. So the index is set up to execute a covered call strategy on a daily basis, and the beauty of that is, not to get too in the weeds here, but it allows you to generate lots of income because the value of an option deteriorates more quickly towards its expiry. So if you're doing this on a daily basis, you can actually generate more income than if you were doing it once a month. And the equity markets don't move that much on a one-day basis, so you're participating very well. So that's what the high income strategy is all about, income plus real equity participation. Everything's done by the index. The strikes for the call are set by index rules. They're a little bit out of the money. They're actually adjusted for volatility, and it's a very nicely calibrated combination to deliver high income but still get the returns of the equity market.
Now, it's basically an overnight option. Is the options market liquid enough for that in terms of you're selling a lot of calls, I guess, on the S&P 500? Does it affect the index at all?
It's a very deep and high volume and rapidly maturing marketplace. one-day options on major indices in the U.S. are about 3 years old, and they have applications well beyond the covered call space. So the volume there and the nice balance of folks on the buy and the sell side makes for a very, very deep and robust market.
So you're not concerned that if the ETF, which is quite sizable now, gets big enough that you're actually your sales are actually going to collapse the overnight volatility?
That market is so much bigger than the ETF that there's really no impact from anything that goes on in our ETF. The market for, because so many people are using those daily options for so many different applications, whether they're for hedging or whether they're for exposure, that it really is so well functioning that there's really nothing happening with regards to the ETF that can really have any real impact on the movement of those options.
And I guess it must be cash settled. So if you sell let's say the strike is 1% above the S&P 500 and the S&P moves 1.5% that day, you would cash settle the difference. You wouldn't actually sell the stocks in the ETF.
Yeah, in the ETF we actually use swap.
Okay.
But anybody could pull up the index and follow the rules for the setting of the strike price every day.
Now, it's a relatively new ETF. It's about a year old.
Yep.
Did you say? What's been the return if we count the income generated? And you said that income comes in. Is it monthly?
Yeah. So the beauty of the strategy is everything's index based. So actually, the income is established by the index too, and it's simply the sum total of the dividends on the underlying and the premiums that are derived from the selling of the calls. So that's established on a monthly basis. And so far, so good. The ETF and the index has been generating over 90% of the returns of the S&P 500, as opposed to less than half from a traditional monthly approach. So it really is a huge, huge game changer. And the income coming off of it has been nicely in the low double digits, which is really very nice for a covered call strategy. So that combination of high income and real equity performance is in many regards a game changer. Think about it from a portfolio perspective. If you were to use a traditional monthly strategy, and if you're an advisor, put in a client account and you get half the returns of the S&P, you're underperforming your benchmark. But with the daily covered call approach, our high income ETF, you can really have equity income that for the first time will really behave like equity. And that's so important in achieving long-term financial goals.
Have you found investors, do they reinvest those months so far? I mean, it's 10 months or so, it's a short period. Are they reinvesting those dividends, or are they actually taking some money out?
You will see reinvestment occasionally, but really the use case is for folks who need the income.
That's a really sort of marvelous idea, because you wouldn't do this yourself. I couldn't imagine trying to have a portfolio and trying to sell overnight options on a portfolio to derive income. I guess people do covered call writing, but you couldn't really do it every day. It'd be pretty hard.
It'd be pretty hard to do dailies yourself. And it's like other ETF innovations. Yes, on an individual basis, on a monthly basis for a few stocks, people have been doing that on a customized basis for decades. But an ETF does allow for the systemic execution of strategies that really would be pretty darn tricky to replicate on your own.
Have you been able to backtest how this strategy would have worked in the sort of a few years back? Backtesting is one. Backtesting is one thing because it doesn't really tell you what will happen in the future. But how does it work in sort of different, when stocks are really in an aggressive rally or just grinding higher or flat, or different scenarios? How is that, if the backtesting has been done, how does that work?
The strategy, the S&P 500 Daily Covered Call Index, is calibrated to deliver the S&P 500's performance. And most of that calibration happens with the snap of a fingers by executing a daily strategy. But indeed, the research that went into the index was to fine-tune that calibration to really deliver S&P 500 performance over time.
Wow, it's a really interesting product. I think I might have to get involved, and maybe someday you guys will get so big in that you will start to weigh on the volatilities. That will be interesting. It'll probably be a good problem to have. So I noticed, I looked at some of your biggest ETFs, Noble, the mid-cap dividend aristocrats, SMDV, those are, it seems like people are really into sort of income, which I guess, as the I guess the baby boomers are really rapidly aging out, but sort of a lot of Gen X people, folks who are maybe a little bit older than us, are really looking for income in a portfolio.
We like the notion of income now and income later. We talked about covered calls as an income now approach. The ability to get double-digit income and equity returns, that's powerful. But also there's the notion of what we like to call income later, which speaks right to the dividend grower suite that we have, the S&P 500 Dividend Aristocrats, the S&P 400 Dividend Aristocrats, and the Russell 2000 Dividend Growers. And the reason we call it income later is because there's powerful compounding of income growth. These are dividend growers. So you take the S&P 500 Dividend Aristocrats. Yeah, they got about a 2.5% yield today, but those dividends have historically been compounding 8, 10, 12% a year, faster than the dividends of the S&P 500. And so you wake up and it's just 5 years from now and you've got a 5 or 6 or 7% yield on your original investment, and that's powerful. And what I find interesting about some of the conversations you hear when you turn on financial TV is people will say interesting things like, oh, the S&P is trading at 20 times. Well, that's only a 5% earnings yield, and that's bad because even with the Fed cut, you could get 4.5% or 4.25% on a money market. But that's forgetting something: growth. The whole point of equities is to grow, and that's what the dividend growers deliver. Because think about it this way: if you owned a stock that wasn't growing its earnings or its dividends, what is it? I submit that it's basically a bond in disguise.
Right.
There's got to be growth, and that's what the dividend growers are about. And for folks who need income now, but then they might live 20 or 30 years, that combination of income now and income later, covered call strategy with a dividend growth, combined with a dividend growth sleeve, that can be a very powerful combination.
I guess one of the great fears is sort of outliving your money, right? If you're 65 years old, you don't want to be 85 and say, well, I'm still pretty healthy, and what have I got left? I think that's a great fear. I mean, certainly, I'm not at retirement now, but I'm thinking about it, right? I want to outlive my money, so it's a powerful, powerful incentive and a powerful product. So just to drill down a little bit, in terms of the dividend growers, and I know you mentioned that some of these companies have grown dividends over time for years and years and years. What kind of businesses can throw off enough income to constantly grow their dividends over time, typically?
Oh, you have to have moats.
Yeah.
You have to have durable business models, because, as an example, with the S&P 500 Dividend Aristocrats, that's a 25-year hurdle. So companies had to actually grow their dividends in the great financial crisis. So you really have to have stability of business models. And again, this is a rare opportunity. They're at a little bit of a discount because of that Mag 7. And historically, you've only seen a sale like this just a couple of times, most obviously right before the tech bubble burst. Not saying it's going to burst this time, because we know the Mag 7 make a lot of money.
Right.
There's a lot of cash there, so I don't want to throw out the doom and gloom, but simply noting that it's been a buy opportunity for those dividend growers historically.
So, before we wrap up, the market has made news have made a lot of spent a lot of news, I should say, about Warren Buffett having $325 billion in cash. He's cashing out of Apple. He's cashing out of Bank of America. I think those have done very well for him. If you were to tell Warren, say, Warren, I have some ideas of where you would put some of that $300 billion, where would you tell him to put it?
Well, as a fellow alum of the good old Columbia Business School, where I just wanted to plug it.
Yeah, sure, of course.
And it is tough to have that much cash. You can do it if you're Warren Buffett, but it's back to outliving your money. Most of us can't have that much cash because we won't reach our long-term goals. The recipe for most of us is the basic endowment model, which means that you have enough cash for 2 or 3 years of expenses, so you don't have to sell in case there's a market crash, but the rest of it better be invested in a balanced portfolio so we don't run out of money. So if Mr. Buffett wants to have a little bit too much cash, that's something most of us can't replicate. We will run out of money if we have too much cash.
Fair enough. Fair enough. And maybe he'll take a look at ISPY. That'll be great.
That would be great. I'll give him a call.
Simeon, thank you so much for being on the show.
Thank you very much.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here tomorrow. Have a good day.